Drake filed his taxes in 15 minutes. He took the standard deduction, entered his W-2, paid everything the IRS asked for, and called it done. He's proud of how fast it went. He also paid $3,000 to $5,000 more than he had to. Daniel earns about the same. His tax prep takes longer. He uses 5 strategies that are completely legal, require no accountant, and are available to any W-2 employee or self-employed person with the right accounts and basic planning. By the end of this video, you'll know exactly what those 5 strategies are and how to start using them before December 31st of this year. Before the strategies, let's look at why this matters more than most people realize. The U.S. has a progressive tax system. You don't pay your top tax rate on all of your income, you pay it only on the portion that falls in each bracket. But if you're in the 22 or 24% bracket, every dollar of taxable income you reduce legally saves you 22 to 24 cents. The 2026 standard deduction for a single filer is approximately $15,000. But there are strategies that reduce your taxable income further, and most people never use them. Strategy 1. Max your health savings account. If you're enrolled in a high-deductible health plan, you're eligible to contribute to a health savings account. For 2026, the contribution limit is roughly $4,300 for an individual and $8,550 for a family. The health savings account has what tax planners call a triple tax advantage. 1. Contributions are pre-tax. You reduce your taxable income by however much you contribute. At a 22% marginal rate, a $4,000 contribution saves you $880 in federal taxes. 2. Growth inside the account is tax-free. The money can be invested like a 401k, and all gains accumulate without being taxed. 3. Withdrawals for qualified medical expenses are tax-free, not tax-deferred, tax-free. Daniel maxes his health savings account every year. He pays medical expenses out of pocket when possible and lets it grow. After age 65, he can withdraw for any expense, like a traditional IRA. A health savings account is the only account in the U.S. tax code with triple tax protection. If you're eligible and not using it, you're leaving money behind. Strategy 2. Tax loss harvesting. If you have a taxable brokerage account, this strategy can reduce your tax bill every single year, even in years when the market goes up overall. Here's how it works. If you hold an investment that has declined in value, you can sell it at a loss. That loss offsets any capital gains you've realized during the year. If your losses exceed your gains, you can deduct up to $3,000 of the excess loss against ordinary income per year and carry forward any remaining loss to future years. I can't sell it at a loss. Then, I've actually lost money. The loss is already real. It's sitting there in the account. Selling it doesn't create the loss, it just captures it in a way the IRS will credit you for. Daniel sells the losing position. He immediately buys a similar but not identical fund, for example, selling one S&P 500 ETF and buying a different broad market index fund. This keeps his market exposure intact and avoids the IRS wash sale rule, which would disallow the loss if he bought the same or substantially identical security within 30 days. The result? He books the loss for tax purposes, stays invested in the market, and reduces his tax bill, turning a paper loss into real tax savings. Strategy 3. Roth conversions in low-income years. A traditional 401k or IRA gives you a tax deduction now, but taxes you on withdrawals in retirement. A Roth IRA is the opposite. You contribute after-tax dollars now, but all growth and withdrawals in retirement are tax-free. A Roth conversion means moving money from a traditional IRA or 401k into a Roth IRA. You pay income tax on the converted amount in the year you convert. But if you're in a low-income year, your marginal tax rate may be lower than it will be in your peak earning years or in retirement. Daniel had a slow year 3 years ago. His income dropped significantly. He used that window to convert $20,000 from his traditional IRA to his Roth IRA at the 12% marginal rate, paying $2,400 in taxes on the conversion. If he waits until retirement and withdraws that same $20,000 at the 22% rate, he would have paid $4,400. He saved $2,000 in taxes by converting at the right time. Strategy 4. Max your tax-advantaged accounts before the deadline and know which deadlines actually matter. Your 401k contribution must be made through payroll by December 31st. The 2026 contribution limit for a 401k is $23,500, with an extra $7,500 allowed as a catch-up contribution if you're 50 or older. Your IRA contribution deadline is different. It's tax day of the following year. For 2026, you have until the April 2027 filing deadline to make your 2026 IRA contribution. The 2026 IRA contribution limit is $7,000, with an additional $1,000 catch-up if you're 50 or older. Wait, I could have put more in my 401k last year? I didn't know I still had time. He had until December 31st for the 401k. He missed it. But he can still make the 2026 Roth IRA contribution by April 2027. Daniel checks his year-to-date contributions in October every year. If he's behind on his 401k max, he increases his contribution percentage for the last 3 months. Every dollar he contributes to a traditional 401k reduces his current year taxable income dollar for dollar. Strategy 5. The home office deduction. For people who qualify. Important note first, the home office deduction is available to self-employed individuals, freelancers, independent contractors, and small business owners. W-2 employees cannot use it under current tax law, even if they work from home. If you work for yourself and use part of your home exclusively and regularly for business, you can deduct a portion of your rent or mortgage interest, utilities, and home insurance proportional to the square footage of the workspace. The simplified IRS method allows you to deduct $5 per square foot of your home office, up to a maximum of 300 square feet, so $1,500 maximum using the simplified method. Alternatively, you can use the actual expense method, calculate the percentage of your home used for business, and apply that percentage to your actual home expenses. This requires more documentation, but often produces a larger deduction. I didn't think I could deduct any of that since I work from home. Self-employed people with dedicated home workspace absolutely can. The space has to be used exclusively for business. A dedicated room or clearly defined area qualifies. Document it, photograph it, keep your square footage calculations. 5 legal ways to reduce your 2026 tax bill. 1. Max your health savings account if you're on a high-deductible health plan. Triple tax advantage. The most efficient account in the U.S. tax code. 2. Tax loss harvesting in your taxable brokerage account. Offset gains with losses. Deduct up to $3,000 against income. Stay in the market by buying a similar fund. 3. Roth conversions in low-income years. Pay taxes at a lower rate now. Withdraw tax-free later. 4. Hit your 401k max by December 31st. Use the IRA deadline tax day of the following year to make last-minute contributions if needed. 5. If you're self-employed and have a dedicated home workspace, take the home office deduction. $5 per square foot up to 300 square feet, or use actual expenses for a larger deduction. None of these are loopholes. They're all in the tax code specifically because Congress wanted to incentivize these behaviors. Use them. This video is for educational purposes only and is not personalized financial advice. Tax rules change annually. Verify all figures at irs.gov or with a qualified tax professional before filing. If this helped you, subscribe. New videos every week covering everything in personal finance that school never taught you. Hit the playlist below to watch the full series from the beginning.